Appreciate that. It's good to catch up with you, especially now. And I remember, boy, it feels like at least a year ago where you described yourself as a fully invested bear. And you've been cautious for a while. That's been pretty clear. I think we've heard you on the network a couple times express your cautious views. But as we begin a new year, how would you describe yourself today?
As being very boring because my views are largely unchanged. When I was on your program last time, and by the way, I think coming on the show and being negative now is like yelling fire in a crowded theater. I think the major plus I see out there is most people are negative, and the market very rarely accommodates to consensus. But what I said in the last program is equities were the best house in the financial asset neighborhood, but I didn't like the neighborhood, and I still don't like the neighborhood. I felt like Pharaoh had a dream. The dream was interpreted by Joseph, and his dream was we're going to have 7 lean years following the 7 fat years. And so I think anybody looking for a new bull market anytime soon is looking the wrong way. We have had the most speculative period in our financial history, SPACs, crypto, weekly, daily options, crazy valuations of the would-be FANGs, and going into a new bull market anytime soon makes no sense to me. And,
well, let me ask you this then. Let me ask you this. How much, you mentioned some of the froth, obviously, that's come out of the market. How much more froth is in? And how much more needs to come out, in your estimation, before you might get a little more optimistic about where we are now and where we might be heading?
Well, you're talking like everything is a monolith. It's not. The stock market is very heterogeneous. So I think there are already some stocks that have bottomed. A typical bear market lasts about a year. Okay, more stocks decline to go up, and the average decline somewhere in the range of 25 to 30%. By that definition, the Russell Index peaked almost 2 years ago, is down 30% from its high. So I think we're finding a lot of stocks that have been through a classic bear market, and I find things that I want to do and own. I just have low expectations for the market because of a number of reasons. The reasons I've outlined previously, but I think we spent a lot of time pulling demand forward. I had lunch the other day with a money manager who lives in Boca Raton, where I have a home, and he mentioned he bought a house down here 3 years ago, paid $1 million for it. It's worth $2 million now. He can't afford to move because he has a 30-year 3% mortgage.
Right.
Negative interest rates, zero interest rates for a long time, pull demand forward, and I think we got to straighten that out. I think labor seems to have the upper hand. There's 1.7 jobs available for everyone looking for a job, so that's going to be difficult for profit margins. But I would basically take the position that we're in a market of stocks rather than a stock market. I expect the S&P very little over the next few years.
Really?
And if you want me to focus on 2023, I would say a 50% chance that we stay in a range of 36 low, 3,600 low, 4,400 high, 5% chance only of going above 4,400, and a 45% chance that we could go into the low 3,000s. And that really depends upon whether the Fed is really going to try to shoot for 2% inflation. If they go for 2% inflation, we have no idea how high rates have to go, because I think inflation's already down at 3 or 4%. And if they're willing to sell for 3 or 4%, the stock market isn't expensive relative to interest rates. You hear all this talk on your program about interest rates in the Fed. That's not the problem. The problem is there's a lack of confidence in the system because we've had these very foolish policies. And, I think that, PE ratios are a function of growth rates, interest rates, and confidence. I went back and looked, I was around in 1972 in the Nifty 50.